Mark thought he had it figured out. He was 34, a software engineer outside Denver making $141,000 a year. And on a Tuesday night in March, he refreshed his brokerage app the way he always did before bed, half expecting nothing, and there it was. $1,004,211. Not a typo, not a rounding error. 7 years of maxing out his 41K, living below his means, and riding the market through 2 ugly corrections had finally added up to 7 figures. He didn't tell anyone that night. He just sat there on the edge of his bed, staring at the number like it might blink first. 18 months later, Mark was sitting in his car in a Chick-fil, a parking lot on a Wednesday afternoon, engine off, not moving, not eating, just staring through the windshield. And here's the part that should bother you. The market hadn't crashed. The economy was fine. Mark hadn't lost his job, hadn't gotten divorced, hadn't made some reckless bet on a meme stock. By every conventional measure, Mark had done everything right. And he was down $2,249,000 from where he should have been. Not lost in the sense of, the account went to zero. Lost in the sense that matters more, the sense almost nobody talks about, which we're going to get into in a minute. But first I want you to sit with that number for a second, because the way Mark lost it is going to be completely different from what you're picturing right now. Here's what you probably assumed happened. You assumed Mark got greedy, chased a hot stock, panicked during a dip, sold at the bottom. That's the story we've all been trained to expect. Crash comes, undisciplined investor panics, loses everything, cautionary tale, roll credits. That is not what happened to Mark. What happened to Mark is that he got scared of losing what he'd built, and he did the responsible sounding thing. He pulled the majority of his portfolio out of equities and moved it into cash and short-term treasuries because $1 million felt too important to risk anymore. He told himself he was being prudent. He told his wife he was protecting the family. He told himself this was what smart money did once you actually had something to lose. He protected it. That's the twist. The villain wasn't recklessness. The villain was safety. And I want to give you the thesis of this entire video right now, in one sentence, because everything after this is just proving it or complicating it. The moment your net worth crosses $1 million is not the moment you've won. It is the single most dangerous moment in your entire financial life, because it's the exact moment most people quietly switch from building wealth to defending it, and defending it wrong is what actually costs you the money. Before we go back to Mark, let's talk about scale, because I want you to understand what club you're actually joining. Depending on which year and which measure you look at, somewhere around 1 in 8 to 1 in 9 American households has a net worth of $1 million or more, once you count home equity, retirement accounts, and investments. That number has grown a lot over the last 2 decades, partly from market growth and partly from home values. So if you hit 7 figures, you are not as rare as the number makes you feel. You are, statistically, a fairly ordinary member of a fairly large and growing group. But here's the uncomfortable follow-up stat. A meaningful chunk of people who cross that threshold don't stay above it for good. They dip back under it, sometimes more than once, over the following decade. Not because the market crashed on them specifically, but because of decisions made in exactly the state Mark was in flush, proud, and suddenly terrified of giving it back. That's the setup. Now let's go back to Mark and let's meet the person who did the opposite thing he did. Carla hit $1 million almost the same month Mark did. Same age, 35. Same rough income bracket, $138,000 a year as a hospital administrator in Ohio. Same amount of time in the market, same general asset mix going in. If you lined up their spreadsheets side by side, the week they both crossed the millionaire line, you would not be able to tell them apart. Here is the only variable that changed. When Carla hit $1 million, she did nothing. Not nothing, as in she ignored her finances. She kept contributing the same percentage of her paycheck she always had. She kept her allocation the same. She didn't rebalance out of fear, and she didn't rebalance out of greed. Either she didn't see the milestone and decide to get aggressive to really make it count. Now, she treated the day she crossed $1 million exactly the same as the day before, when she had $998,000. 18 months later, on the same week Mark was sitting in that parking lot, Carla's number was $2,253,000. Same starting point, same market, Same 18 months, a $4,000 gap turned into a gap of over $2 million, and the only thing that changed between them was what each of them did emotionally the moment the number in the account started to feel real. Here's what nobody tells you about the first million. It doesn't feel like money. It feels like a responsibility. And responsibility triggers a completely different part of your brain than opportunity does. Building wealth uses the part of you that tolerates risk because you have nothing to protect yet. Once the account crosses that line, most people flip, often without noticing, into the part of the brain that treats the number as something to guard, like it's a physical object sitting in a vault instead of a moving, working process. That flip is the whole ball game. It's not a metaphor. Either it shows up in actual portfolio allocation data. People who become decamillionaires in a single dramatic event, like an inheritance or a sudden windfall, tend to move a much larger share of that money into cash and low-yield holdings within the following year compared to people who build the same net worth slowly through steady saving. The slow builders keep behaving like builders. The sudden arrivers start behaving like guards. Let's be fair here for a second because I don't want to oversell this. Not every study on windfall behavior agrees on the exact size of the effect, and some researchers have pushed back on how universal this pattern really is. People's reactions to sudden money vary a lot by age, by how financially literate they already were, by whether they grew up with money or without it. This isn't a law of physics, but the direction of the effect shows up again and again, even in the more conservative studies, and that direction is the same one Mark fell into. Let's meet Diana, 38, marketing director in Austin, and about 2 years ago, her net worth crossed $1.1 million. Diana's mistake wasn't Mark's mistake. Diana didn't move to cash. Diana's mistake was thinking she was richer than she actually was, because a big chunk of that $1.1 million was sitting in her house. Here's the number that corrects the misconception. Of Diana's $1.1 million, $410,000 was home equity, money that felt just as real to her as her brokerage account, except she couldn't spend it, couldn't rebalance it, and couldn't access it without either selling the house or taking on debt against it. When her company had layoffs and she got nervous about her job security, she went looking at her $1 million net worth for comfort and realized barely $600,000 of it was actually liquid enough to help her in an emergency. This is what people call the liquidity illusion, and it's incredibly common the first time someone crosses the seven-figure line, because home equity gets counted in every net worth calculator you'll ever see, but it behaves nothing like the rest of your portfolio when life actually needs cash fast. Now let's meet Maya, and Maya's story is about a number so small it feels stupid to worry about until you see what it becomes. Maya, 32, hit $1 million and decided, reasonably, that managing that much money by herself felt like too much responsibility. So she hired a financial advisor who charged the industry standard fee, about 1% of assets under management per year. On $1 million, that's $10,000 a year. Doesn't sound insane. Feels almost like a rounding error next to seven figures. Here's the number that corrects that. Assuming a reasonably normal long-term market return, that 1% annual fee, compounded over 30 years, doesn't cost Maya $300,000, which is what you'd get if you just multiplied $10,000 by 30 years. It costs her closer to a third of her entire ending balance, because that fee isn't just taking money out of the account, it's taking money out of the account before that money ever gets the chance to compound. It's the compounding you lose, not just the fee you pay. To be fair to financial advisors for a second, because this isn't a fire your advisor video, a good advisor who keeps you from doing what Mark did, who stops you from panic selling or panic hoarding at exactly the moment you're most tempted to, can easily be worth more than 1% a year in. The mistakes they prevent. The fee isn't automatically a ripoff, but you should know the actual 30-year price tag before you decide it's worth it, instead of anchoring on the $10,000 number that sounds small. So we've got the fee. Let's stack a couple more. A lot of new millionaires in that first year or two upgrade their house. Feels earned, feels proportionate. Say that upgrade means an extra $1,500 a month in mortgage, taxes, and maintenance compared to staying put. That's $18,000 a year, which again sounds survivable next to $1 million net worth. Run that $18,000 a year as money that would have otherwise gone into the market over 25 years, and you're not looking at $450,000. You're looking at well over $1 million once you let it compound the way the rest of the portfolio would have. Then there's lifestyle creep, which is quieter than the house and sneakier than the fee. The nicer car, the extra vacations, the subscriptions, the dinners out that used to be occasional and are now just Tuesday. Say it's an extra $800 a month that would have gone toward investing and didn't. Over 25 years, compounded. That's the difference between retiring comfortably and retiring extremely comfortably. And most people who let it happen never even notice the moment it started, because none of these decisions feel big individually. That's exactly why they work. So let's go back to that Chick-fil-A parking lot. Mark wasn't sitting there because he'd lost his job or because the market crashed. He was sitting there because he'd finally pulled up the numbers side by side and realized that the safe decision he made the week, he crossed $1 million, had been quietly working against him for a year and a half. Not through some dramatic loss, through absence, through money that should have been compounding sitting flat in cash instead, missing one of the strongest stretches the market had in years, because Mark had decided $1 million was too precious to keep exposed to risk. He didn't lose the money in any account statement sense. He lost it in the sense that it never became what it was supposed to become. And that kind of loss doesn't show up as a red number. It shows up as silence, as a number that should have kept climbing and just didn't. Here's the bigger idea underneath all of this. The one thing I want you to actually walk away with. Most people treat their net worth like an object, a trophy on a shelf, something you build once and then protect, the same way you'd protect a painting or a stack of cash under the mattress. But money that's actually working for you isn't an object, it's a process. It's not a thing you finish building and then guard. It's a machine that only keeps producing more of itself if you keep letting it run the way it was designed to run. The moment you start treating the process like an object, the moment you decide it's done and needs protecting instead of continuing, is the moment it stops compounding the way it was supposed to. Carla understood, whether she could have explained it this clearly or not, that $1 million wasn't a finish line. It was a number on a machine that was still running. So here's the actual advice, and I promise it's simpler than you're expecting. When your net worth crosses that line $1 million, or honestly any milestone that makes you suddenly aware of how much you have to lose, the correct response in almost every ordinary situation is nothing. Not a bold new strategy, not a dramatic shift to safety, not a reward yourself upgrade, nothing. Keep doing exactly what got you there. That's not a satisfying answer to hear, and it's an even harder one to actually live by, because every instinct in you is going to be screaming that a number this big deserves a big decision. It doesn't. It deserves the same boring discipline that built it, running for another 20 years without you touching it out of fear. Here's the question I want you to actually sit with. The one Mark wishes someone had asked him that Tuesday night, instead of just letting him refresh the app and go to bed. When the number finally gets big enough to scare you, are you going to protect it, or are you going to let it keep working? And if that question just made you think about the day you'll actually need to start pulling money out instead of putting it in, that's a completely different problem with its own completely different mistakes people make. That one's next.